45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979. Welcome everybody. Real quick before we get started, I just want to see if you guys can hear us. Please let us know in the chat. Let us know if you guys can hear us. Give us like a yes, a thumbs up. We can hear you. Just let us know in the chat. Awesome. Well, what's up, everybody? Happy Tuesday. I'm very stoked to have you guys on tonight. Also, go Dodgers. Hoping to get the sweep today. Big Dodgers fan. So for all of you LA Dodgers fans here, very excited for another good game. And I'm just excited to kind of dive more into the consult. So a little about me. I am a realtor and advisor here in Orange County, as well as I'm your mortgage fund consultant. So I have a substantial position in the fund myself, and I really go along with what we believe here at Marshall Reddick, that it's extremely important to subscribe to what we talk about. And that's why you'll find a lot of staff members here at Marshall Reddick also invest and believe in the mortgage fund. And that's why we're going to talk about why you should too. And a little bit about our agenda tonight. So first we're going to go over, hey, what's new with the fund? What have we seen recently? Let's talk about, we're going to talk about Q3, some of the details, the waterfall. We'll dive into the basics. Some of you may be very familiar with the fund. Maybe you've had a position for a while. Others of you, maybe this is your very first time. And so we'll just kind of go over high level and then kind of dive in more deep into details about the mortgage fund. And then also we want to talk about some of the metrics throughout the portfolio and then what we can look forward to. Without further ado, I want to pass it over to Pat Prunty. He's going to be the fund manager, and he's also a good mentor of mine.
Yeah, thanks everybody. A pleasure to be with you this evening, and just to talk about another fabulous quarter that we had, the third quarter here in 2024, and just extremely impressed with what we continue to do here. It's a complete team effort. It's just my pleasure to be the manager, director of our private lending team, a member of our loan committee, working here in the Newport office with Cameron and our brilliant team. And we have just so many synergies amongst our Marshall Reddick business, a lot of competitive edges to some of the other lending institutions that are out there, non-bank private lending institutions. They just lack that brokerage arm that we have. They lack that property management arm that we have. They lack that kind of national footprint that we've built with our offices, of course, here in California, but as well as in Texas and Tennessee and in Florida. So again, just thrilled to be with you. Thanks so much for taking the time out of your day, especially while we've got World Series going on. And, I'm with Cam. I'm a huge baseball fan. I'd love to see a few more games, but I know us all here in Los Angeles would love to see that sweep tonight.
Absolutely.
So we'll get through it the best that we can. And again, thanks for your time.
Yeah, so Pat, what is the Marshall Reddick Mortgage Fund?
It's a great question, and it's always a good one to get started with because we do get a lot of new folks on the call all the time, and that's what it's for. It's, of course, for the folks that have been with us a long time, some of those tried and true investors, but for the new folks, it's a private debt fund. All we do is lend money, but we take capital from, people here in California and all over the country, all over the world, but they must be accredited investors. And we're lending that money out. Again, we're a debt fund only, and we're lending it to real estate entrepreneurs, investors, developers, folks that need capital to operate their residential real estate business.
Yeah. And I heard you mention what's an accredited investor. Maybe if you can kind of go over that in the next slide here.
Yeah, absolutely. Continuing on just briefly before we get there in terms of, what the fund actually is and its focus. Certainly, we are strictly first lien position and secured against residential real estate. So no commercial, no mixed use, no industrial, no office, nothing like that. And as you'll find, those have been tracking with us, and as you'll see in this presentation, we love single family homes. And we're strictly looking for good reasonable loan to values with good borrower skin in the game. And we're looking for non-owner occupied scenarios only. So your primary residence owner, they cannot and should not borrow from us. Those folks are more suited for the standard financial institution, your bank or your CMG. As far as the accredited investors, the folks who contribute capital and who really enjoy this business model that we've employed, they receive a quarterly earnings distribution. And I love to tout the fact that we have not missed a quarter. We are in our 19th operational quarter now, and we have, of course, 19 corresponding profitable distributions. The distribution is based on two factors. That's a preferred rate of return, and in addition to that, a share of the profits. And both of those percentages are based on your capital account size. So when we get into the preferred return, which is a 6%, and the varying profit splits that we've employed, you just easily multiply those times your capital account to come out with your quarterly or annual return. Our target return net to investors, so net being, of course, after expenses, but before profit splits, is 8% per year. And let me correct myself there. It's after the profit split. Our target return is the 8%. So my apologies for misspeaking there. There you go, Cameron. Here's your question in terms of the accredited investor. You get that a lot, don't you?
Totally, all the time.
Yeah, no, it's so interesting. This is a government term. It's not a Marshall Reddick term. Certainly, we love to take capital from anyone who's willing to give it to us, but there is a place for this. And the government's idea here is that they want us to be working with folks who have high incomes or have a reasonable net worth. And oftentimes folks in those two categories have a good understanding of investments, especially alternative investments, which is what we're considered. We're a Regulation D506C, which restricts us from taking these investments from accredited investors. So this is a very common term. This is not something that's unique to our type of business, and it's certainly for alternative investments, not something that's stocks, bonds, mutual funds, something that's publicly traded on the Dow and so on.
Awesome. Now that we know where the capital comes from, who's borrowing the capital?
Certainly. Again, as I mentioned, it's going to be those entrepreneurs, those real estate investors, those developers. We work with a lot of we buy houses for cash type groups, and I'm sure in whatever community you're in, you see those signs around town. I'm certainly seeing a lot more of that on the radio. I see a lot of ads for that, and certainly on television now, there's a lot of those. Hey, don't pay any commissions. Don't do any fix up. Just sell me your house for cash. What they forgot to mention there is that they're buying at a discount, as they've obviously got to undertake the fix up. But it's those types of groups. It's also new home builders, right? There's a lot of entrepreneurial new home builders. This is certainly not D.R. Horton or Lennar. But we also have a lot of Marshall Reddick clients too that are buying land and building homes. But again, these are non-owner occupied. These would either be spec homes for sale, or these would be build to refinance and hold. That's also a really popular strategy we're seeing a lot of. But we do a lot of unique type lending as well that some institutions don't. So one of those specific niches that we fill is for the self-directed retirement account. And I'm sure a lot of folks on this call have heard of that self-directed retirement account. You can certainly invest in our fund using one too, but a lot of folks are looking to build a rental portfolio or an investment property portfolio using their IRA. If you're going to pay cash for the home, certainly that's one option. But if you want to lever and borrow along with your down payment to buy that property again inside your self-directed retirement account, you need a special loan called a non-recourse loan. And I find that most private lenders around the country do not offer non-recourse debt. Why? I can't figure it out, as they're generally at lower loan to values. But these are extremely safe loans, and we do have some element, not a lot, because a lot of times these are longer term loans, but 15% of our capital stack is going to be in those longer term loans that are non-recourse, specifically for self-directed retirement accounts. And then, of course, we certainly help our Marshall Reddick clients, and that's us giving back to our brokerage. So we have a lot of folks that are, Marshall Reddick clients coming to us and working with Cam and our other advisory team and our local realtors, again, whether that's here in California, Texas, Tennessee, or Florida, and those unique situations pop up. There's a lot of home builders out there that we're working with that are buying, developing, going vertical. So, it's good that we control the capital. We make common sense loans in common sense situations that aren't always tied to somebody else's guidelines that can be prohibitive or problematic. And it really allows us to control a lot of the unique situations.
Yeah, that's awesome. And well, maybe you can help us understand what's the capital call process like. I've definitely got questions on what's the subscription account? Is there a waiting rooms? I'd love for you to answer that one for us.
Totally, and I'm going to dive into this a little bit more specifically as we continue the call. We had a little bit of a spike in the hold period in the third quarter, and I'll be happy to talk about that. But overall, for everyone's perspective, many different types of funds manage their capital call process differently. For us as a debt fund who's constantly funding loans, who's constantly receiving payoffs, who's constantly managing our construction and renovation draw process, certainly a lot of our loans have construction or renovation holdback. We've got to handle that process very specifically. And we do it with what we call a waiting room. And this is applicable to each new contribution that's deposited. So we don't just say, hey, you're confirming that you're going to contribute $100,000 to the fund, and then we wait and we do a capital call and we raise capital at one time for one trigger event. That's how a lot of syndications might do it for the purchase of an asset. But for us, again, there's many loans being funded. It's almost a daily process, and certainly some of our construction and renovation draws are done multiple per day. In some cases, we've had as many as 100 construction draws in a particular month. So what we do is we are talking to folks constantly. We're always raising capital. And after you sign your paperwork, we intake your dollars into our subscription account. And this is the waiting room. And you're waiting to be admitted to the fund. And of course, it's our desire to move you out of that waiting room and admit you to the fund as soon as humanly possible. And this is generally not a big deal. Since inception, again, 19, we're now in our 20th operational quarter. The average wait time in the subscription account or the wait room is 24 days. Sometimes it's less than that. Sometimes it's 0, and sometimes it's longer than that. And this is a mechanism that we use to avoid yield dilution, which is important to all capital partners in this fund. Everybody has gone through the similar wait room, and you do not want new capital that also comes in spikes to be dropped into our operating account and to eat up some of those returns that are being generated from your capital that was invested in a prior period. So again, this is a common in the debt fund space. Again, it's our mechanism to avoid the yield dilution. And it's important that this is each contribution is subject to this wait only one time, but it's applicable to each contribution with the one exception of reinvestments. So we have a lot of folks who, like a stock bond or a mutual fund, reinvest their earnings every quarter. Those do not go through the wait room. So that's really important to understand. Those are added to your capital account on the start of each quarter and are earning from day one. So again, from my perspective, not a big deal. And I'm someone who personally, like you, Cam, who has invested a lot of money into this fund and who is doing so on a regular basis. A lot of our folks are joining me and getting into like what I call a capital drip campaign, where they might be putting in $5,000 a month or maybe $20,000 a quarter or something like that. For me personally, I'm putting in a couple of grand on the 1st and the 15th of every month, and I'm just building my exposure over time. This happens automatically with debits from my bank account. All of those are going through this wait room, but I don't even think about it because, again, I know sometimes it's 2 or 3 days that it waits, sometimes it's 40 days that it waits, but on average it's about 24 days. And it's just the process that we all need to go through. As for the return on investment, that is a big question that I always get. And why not? Let's get right to it. So we talked about our 19 quarters since inception. of this particular fund, and I love showing this graph. So it's two-toned, right, with green and dark gray, and the bottom line here is the bar graphs represent our after expenses net quarterly earnings. This is the one where that top line for earnings there at the bottom is before profit split. And then the two lines below earnings, so partners and management, is the breakdown, including the profit split. And so for the capital partners, this is based on our standard profit split tier, which is 50-50 after the preferred return is paid. And again, goes to show our consistency in our mission of our targeted 8% return with extremely low risk. Right, and that is all boils down to loan to value, which I'm going to dive in here as we dive into the metrics from the third quarter.
Yeah, and I know, Pat, you mentioned the standard profit split is a 50-50, but I just want you guys, don't forget that we've introduced higher profit splits. It was launched in 2024, but it's not like brand new, and it hasn't affected anyone negatively. So no one is being penalized for this. We as a manager are essentially taking less profit and giving higher profit splits to investors with higher positions in the fund. And if you see here, we have a couple examples. So for instance, anything that's below or less than 500,000, you're receiving that 500 or 50% profit split. Anything that's above 500,000, well, the profit split now moves to 60%, and basically Marshall Reddick taking 40%. And then it increases if you have a position above 3 million, where that profit split's actually now jumped up to 70%. So I just want to remind you guys of that. It's not brand new, but it is something that I want to make sure it's on your radar.
Absolutely, and the returns that we're showing on the screen here, ranging from the 8.6 for the capital accounts under 500,000 up to the 8.88, as you can see in the footnote, is based on our quarter three earnings that we just launched last Friday. I'm sure most folks on the call got that quarterly memo. We certainly posted that to the website. And be advised that when it comes to capital account, this is based on investing entity, and this is not cumulative for those folks who perhaps have multiple investing entities. I mentioned before you can invest with a self-directed retirement account. That's certainly something that's very popular to either go tax deferred or tax free, depending on if you've got a traditional or Roth IRA. But if you have that in addition to, say, a personal account or maybe an LLC account or something like that from which you're investing, that these preferred profit splits are based on investing entity, not on the individual who has multiple investing entities.
Yeah, and let's talk about what's new. Oh my gosh, 60 million. Pat, that's incredible.
Well, in the grand scheme of things, I've learned by being in the money business that this isn't a ton of money, but for us in a very, very conservative mindset, in an income and dividend type fund mindset and design, we've just desired to just continue to slowly move that capital stack upwards. Our goal when we launched this fund back in 2020 was to go to 100 million. And we weren't sure exactly how long that was going to take, but we know that we didn't want to rush there and have poor yield distribution. And so we're extremely satisfied with the capital that we have today. And certainly we've raised well in excess of 60 million. That's just what we have net today. That includes, of course, all of the redemptions that we've had over the years, which is a very important question that we're going to dive into, right? Because if you're going to invest, you need to know how and when and what the mechanism for getting your funds out. But nonetheless, this is a great milestone, and I'm extremely proud as we march our way towards our goal of 100 million. And we couldn't do it without our capital partners. A lot of those folks on the call tonight, a lot that couldn't make it, and a lot that are out there that are very interested in joining these 300, right? Certainly this is a moving target, and again, is a net, including folks that have come in and then have taken their capital out. And this was as of October 1st. So we're marching, up towards 315 at present, and we'd love to have everybody else who's interested give us a look. And certainly that's a very easy process to do by having a conversation with somebody as knowledgeable and as good looking as Cameron Carlson.
Comes from you, Pat.
So What else is new besides obviously those fantastic milestones? We have absolutely learned that the focus in this fund has to be lasered on short-term loans. And there's a number of reasons for this. Definitely in a volatile interest rate market, which is, maybe subsided a little bit. Now we've seen one rate drop, maybe some others coming, but for the last couple of years, it's pretty volatile on the upward swing. So the shorter terms allow us for quick rate adjustments as needed and to avoid interest rate risk. But it also allows us for more frequent origination and extension fees. From the borrower's perspective, they certainly don't like that, but it's pretty common. 12-month loan terms in this space are the standard, but in some cases we're even able to get 3, 6, or 9-month terms, and we're really not looking at anything above 24 to 36 months. And even for those 24 to 36-month loan terms, we're keeping that to a minimum, more like 15% of the capital stack, where it's between 80 and 85 have to be in 12-month terms or less. We've got some cool graphs and metrics on that to come. But don't forget about the liquidity that I mentioned, right? Everybody needs to understand how awesome and how well our liquidity policy works. And the reason for that is, after doing this for so many years, and certainly as of 10/1 or October 1st, we had a little more than 250 loans. That's ticked up now to almost 270. We've literally got a payoff happening every single day. And that velocity of money helps us not only drive the yield, but helps us remain that liquidity, because with that incoming capital from those payoffs, we are immediately funding new loans that are in queue. We are immediately funding construction and renovation draws from our borrowers. And we're also taking out those capital partners who desire to redeem, and sometimes that's just what you need to do. Sometimes it's a retirement thing. Sometimes it's the purchase of another larger asset like a new home. But just understand that there is a good mechanism to get out. And I do enjoy our liquidity policy. One of those metrics here that I'll mention is something that I have been tracking, which is a weighted average loan term. And the weighted average comes from the size of the loan amount. So certainly a higher loan amount at a longer term would be much different than a lower loan amount at a shorter term. So we weight the average, and the green dotted line here is our trend line. And you can just see over the past few years, since we've had the rising interest rates, our desire to focus on those shorter terms. So this is execution perfectly as set up by our management team and by our loan committee. And we're going to continue to focus on this. And even in this quarter, this last one we just had, we drove it down under a 12-month average. Speaking in the same terms, in the last handful of quarters, I've been showing the origination and payoff data. I'm also coupling that up with the capital data, and I'm going to kind of get granular here as to something that I saw when doing the analysis on this call about our spike in capital in the waiting room. So kind of have that thinking cap on. But nonetheless, we had 43 loans that paid off in the quarter, and that was a 13.09 million in total volume. The weighted average loan term for these 43 was 12.20 months. So that's pretty low, right? We're taking in that capital, we're going to be putting out it again. And the average interest rate on these 43 loans was 10.22%. So again, a fabulous number. In the preceding few quarters, it had been in the 9s, right? So what we are implementing is working. Again, a focus on shorter terms and higher coupons. So the new loans that we originated, 50, that's a record for the quarter, was 13.8. So we effectively pushed out exactly how much money we brought back in. And on these 50, we're again lowering that weighted term. We're now under the 12 months, as I just mentioned. And we're quite similar in our coupon rate there. Our average interest rate, again, weighted at 10.18%. To add to that I haven't in some of these prior calls, the intake of new capital, that's just new, fresh capital contributions coming in, is 3.21 million. So keep those in mind as we move into this next analysis, which is going to be our comparison of Q2 versus Q3. And again, some of the same metrics there, just having them side by side from our prior quarters. So in Q2, which I shared, we had 9.65 million coming in, and we pushed out in originations 4.41 with 3.65 million in new capital coming in. Compare that to Q3. So we had quite the spike in payoffs, which is extremely difficult to predict. And of course, we love the incoming capital, allows us to deploy the funds and earn new loan fees and deploy at potentially higher interest rates. But in this case, in this comparison, our originations were essentially unchanged and our new capital was very minor, essentially unchanged. So this dynamic here, taking us into our next slide, is that payoffs were up and originations in capital, again, essentially unchanged. So this spike in these payoffs created an increase in the subscription account hold for the capital partners with incoming contributions at the end of Q2 and the beginning of Q3. Again, I don't desire to hold your dollars there. I desire to move those as fast as possible, but I do have a fiduciary responsibility to our 300 capital partners not to dilute their yield. And that is what I'm doing here. So I apologize for those folks who had a longer than the 24-day since inception average. But again, it's our desire to move it. And again, this dynamic is extremely unpredictable. There's just so many moving parts in what I like to call the chessboard that we're dealing with as a loan committee every single day, with the goal of literally keeping $0 in the operating account every second of the day. Because if we have no money in the account, that's because it's out earning 9, 10, 11, 12% interest rates and 2 points every time we originate a new loan. That is how we're able to keep the yield where we're able in a very competitive and volatile interest rate market.
Thanks, Pat. That was very detailed. I appreciate the explanation. Maybe if we can kind of just dive into some of the basics of the fund.
Totally, I'd love to do that. I just had to kind of get out there. There was a lot of folks that were really intrigued by what was going on during the quarter, and those things just kind of seemed to tie together with some of those metrics that I wanted to share.
Absolutely, I appreciate that. And honestly, some of the easiest metrics or basics that we can explain is the question of, hey, what is the minimum investment and how long is the minimum hold for that investment? Well, for the minimum investment, that's going to be $25,000. And the minimum hold is going to be 1 year or 12 months. I know Pat mentioned that. And when you make that investment, you really have two options. And it kind of depends on what your goals are. Option one is you can choose to automatically reinvest those funds every quarter, or you can choose to take it out. And so if your goal is to have this compound and build up, I know for me, I choose to reinvest it. Or maybe your goal is to use it as some sort of cash flow, and it's a part of your expenses. That's something that you can elect up front. But regardless, just so you know, earnings are taxable. And Pat will kind of explain what tax side looks like and what forms you'll receive. But it's just important to know you can choose how to make those reinvestments. Also, and if you want to redeem, you can redeem part or you can redeem your full investment. And usually that takes about 90 days or less. And so an example for myself is I redeem part of my capital in order to purchase real estate investment, and I use it for the down payment. And then I continue to build that fund up, and should I see an opportunity in the next couple of years that I deem, to pull more capital out, that's an example of what you might redeem funds for.
Absolutely, and thanks for sharing. And these basics here are by design, right? We wanted a low minimum investment and a low minimum hold so that folks could get comfortable with what we're doing. We're extremely confident in that, and I think that our historical performance shows that. As far as the earnings being taxable, I'm just going to hit on that again really quickly. A lot of folks think, oh my gosh, well, I can reinvest the capital and take advantage of that compounding like Cameron and I do as like a forced savings plan. But unfortunately, regardless of whether you reinvest or take the cash, it is still a taxable event. The only way to avoid the tax is to invest with a self-directed retirement account, which again would either be traditional or Roth, and therefore tax deferred or tax free. We have something like, I don't know, 75 to 80 of our 300 plus positions are self-directed retirement accounts, includes everything from a solo 401k to a defined benefit plan and so on. We'll entertain unique scenarios as possible as long as we're able. And as Cameron mentioned, the redemption process, no problem. Oftentimes we're able to do it less than 90 days. It's just important that when you get to the heavy reading, when it comes to our private placement or our subscription agreements and our various different business plan, that the paperwork will state that you need to give us 90 days to redeem, right? This is certainly not something that's liquid like Vanguard or Bank of America, where you snap your fingers or click a button and the funds are back to you the next day. Again, we want to have our capital deployed in 6 to 12 month loan terms at really good loan to values. And while those are paying off regularly, we need to have an orderly queue of funding of new loans, funding of construction draws, along with those redemptions that need to happen. And so far, so good. Redemptions are a part of the ongoing business operation. And I'll even be showing, what the redemptions were for this last quarter as we move through. In terms of continued basics here, we are currently a California partnership. There is a lot of talk about moving to a different structure, including a REIT for some tax benefits, but there's going to be some potential changes to some of the laws that govern the REIT status. So one thing, if I can comment, is get out there and vote, right? We've got a presidential election and a lot of bills that are out there in 1 week from now. So do your civic duty. I certainly took the time to do it. But we are looking at changing from a California partnership, but currently you will still receive a K-1. Every investor receives that. It's just a tax document that reports to the IRS and to the state. And certainly talk to your tax professional if you're interested, just ask them. And if you'd like to see a copy of my K-1, or I'm sure Cameron wouldn't mind sharing his, we're happy to provide that, so that you can share that with your tax professional. There's nothing hiding there. It's just straight up income. And, that at least can share with your tax professional to see how that is going to affect your overall taxable liability as it shakes out on your 1040. When it comes to investing with a self-directed retirement account, know that there is no unrelated business taxable income. Anybody that knows what a self-directed retirement account is has heard of that. And I also happen to think that the reinvestment option is extremely key. A lot of folks that are using retirement accounts, they get income off of whatever their investment is, but the dividends and the income is too low to invest into something else. And so you end up with cash drag where your earnings are not earning on themselves, where you can do that with Marshall Reddick Mortgage Fund. And don't forget, you have to be an accredited investor. We have no choice in the matter. As far as how we make money, again, we're a debt fund. So every time we make a loan, we earn loan fees. And then during the term of the loan, we earn interest. So our target in terms of loan fees at origination is 2%. Sometimes it's a little less. It's a very competitive market. And on the interest rate, the coupon rate, we're looking for 10 to 12%. And if you add those two up on a 12-month loan term, we're annualizing between 12 to 14%. Our net target to investor is the 8%. We're beating that. And in order to get there, we need 12.5% gross on the money. And again, we're accomplishing that. So we've got to earn 12.5% on the entire capital stack in order to be able to return 8% net to the investor after our expenses, including third-party expenses, including the management fee, and so on. So the net to investor return has two elements. Again, a preferred return. Everybody earns 6%. that is paid before the manager, Marshall Reddick, participates in any split of the profits. And then, of course, thereafter, as Cameron shared, we do have varying profit splits. The standard since inception has always been 50%. And thereafter, for larger capital accounts, 60% for 500 or better, or 70% for 3 million or better. Marshall Reddick's side is the manager. Certainly, we employ the entire staff that manages the operations of the fund. And so that is what the 2% management fee, that is an expense to the fund, covers. That's not a profit center. That literally is just covering the staff that makes the magic happen. In terms of how we make money, that comes from our share of the profits, which again is going to be dependent on your capital account. And so we're either going to be taking, after the preferred return, the other 50, 40, or 30%.
Yeah, thanks, Pat. And just to give you some figures here, as of October 1st this year, we have a total of 60.28 million in investor capital. And when you take a look at the returns, and based on the 50-50 profit split, I know we have several tiers, so we'll go off 50-50. Since inception, we are at about an 8.55% average. If you take a look at just the last year, we're at about an 8.38. In the last 3 years, about an 8.3. And something that's very important is when you're looking at all of these figures, these are over 9 operational quarters. So 9 consistent recorders that are giving us the average of about 8.55. That's huge.
Absolutely. I'm looking forward to our 20th and then onward to 100 quarters in a row without missing an earnings distribution.
Awesome. And you may be asking, well, where can I find more? Where can I find these details? Of course, you'll have this webinar in the slide deck after we finish presentation, but please check out our website. It's so important. You can really see the memos. You can see the written reports. You can even see a spatial map of everywhere where our loans are. You can click on every single loan that's invested. You can see obviously the performance of the fund, the breakdown of the waterfall. Everything's on our website. Highly encourage you guys to check out the fund on our website.
Yeah, let's get into the nitty gritty, the net income and the waterfall. This is a very simple process, but some people get confused. So I'd like to dive into that and to define the waterfall, which is how investment returns are allocated among participants in a pooled investment. Certainly the mortgage fund is a pooled investment. Note that we're distributing 100% of total net income each quarter. That's after an allocation of the loan loss reserve. I'll speak about that. And of course, after that, we're looking at our preferred return, which is 1.5% per quarter, of course, 6% per annum, and then the varying profit split dependent on capital account. So here's a snapshot of our profit and loss. This was included in the memo that I issued last Friday. This is now also uploaded onto the website that we just saw in a slide or two beforehand. So very consistent with our past quarters, just obviously higher revenue, higher expenses, higher net income, quarter over quarter over quarter. But if we go and we look to break that down and how that actually translates into percentages in dollars, that net income, that 1.47 basically, represented a 2.53% quarterly earnings, which annualizes there a little over 10%. That is before profit splits. Okay, so out of that, 885,000 is representative of our 1.5% quarterly preferred return. And again, our fund is one where you can enter at any point during the quarter, right? So this is a pretty complicated math formula. We don't just have static starting capital and static ending capital at the end of every quarter, right? There's just a daily income of capital, and there's also not daily, but there are regular redemptions and exits of capital. On top of course, or the balance of to be distributed of that 1.47 million is our profit to split, right? Which is about 583,000, which represents 1.03% per quarter, and then annualized at a little over 4%. And then you can see what that percentage is. Again, these percentages would be multiplied times your capital account to get to what your return was. Again, difficult to calculate if you have incoming contributions or investments during the quarter. Those certainly do earn during the quarter, but they earn pro rata. However, if your capital was static at the start and the end of the quarter, you should easily be able to apply your capital account with these formulas to arrive at your total return. So the total to the capital partners based on the varying profit splits I have here, and again, range from 8.06% annualized up to 8.88% annualized at our highest profit split tier. So that is the waterfall, and those are the actual numbers from quarter three. I haven't shown the balance sheet in the past on the investor call. Again, it's been a part of all of the investor letters, and they're all listed on the website, so certainly welcome to take a look at that. But I had a number of questions this quarter with regard to our loss reserve, and so I wanted to point that out. I'll tick back one slide here. You can see here the loss reserve is listed at 52,776.29, which is where on this slide I'm getting that number. That was the allocation for Q3, which is a tiny percentage of income and an even tinier position of our overall capital. Okay, so this is a non-tax deductible expense to our fund, and is a reserve for expected credit losses, right? We didn't have any credit losses, but the way GAAP and third-party audits work is that they require an allocation for expected future credit losses. And so this loss reserve expense accumulates on our balance sheet, which I'm showing here. So you can see the allowance for loss reserve and an accumulated amount of $290,000. That is our loss reserve over time, which is an allowance and will offset future actual incurred credit losses if we incur those. If we don't, well, we adjust our loss reserve on an annual basis going forward, and we will lower it so that we're not over accumulating. Okay, but this is not something that's specific to our fund. This is very common to many funds, including debt funds, and again, is a requirement for a third-party audit.
So, well, let's just take a look at what would it look like if you were to invest 500,000 capital, if you had a 500,000 capital account right now with our current figures.
Yeah, and that'd be based on our second profit tier.
Correct, yeah, and so that's going to be based on that 60% profit tier that we mentioned. So your preferred return right off the bat would be 7,500 for the quarter. And then when you look at the profit share with the 60%, you're going to be looking at 3,090, and your total return is 10,590, which comes out to about 2.118%. And once again, these are based on our Q3 earnings, or our Q3 quarter. And then if you take a look at the annualized return, we're looking at about 30,000 for your preferred return. Your profit share is 12,360, and your total return is 42,360, or in percentage wise, 8.472. And when we're looking at these figures, once again, I just have to remind us that this is a super, super safe investment. We're talking 19 quarters in a row of hitting a return. It's just incredible. And maybe Pat, if you wanted to weigh into that too.
Yeah, we're going to get into the diversity. We're going to get into the low risk, which from my perspective as a debt lender really boils down to loan to value and desirability of asset. And we're very keen into both of those metrics. So let's get into those. Bottom line, these are as of October 1st. Super well diversified, and we're super proud of that. So we're more than 15 states. Some states that we're in are very low number of loans, so I don't necessarily count those, but we've got 15 like really core states. And the percentages that I have here in the top 4 states are all based on capital. So I'm going to speak to Florida, you know, in a couple of slides as well, but that 23% is a little high. It's a little uncomfortable for us. We had it as high as 25%. We're very conscious of that. And we don't really want any single one state, just as you can see below here. We also don't want any single capital partner or any borrower or any loan to represent more than 10% of the portfolio. The 10% doesn't necessarily apply to the state, but I do think a well-rounded allocation between the states is very important. And it's also just important to limit exposure to some of those boom or bust states. Certainly Florida, from a historical standpoint, has gone significantly up. It has also gone significantly down over the long trend. It's certainly on the way up, as is all residential real estate. But just know that we are constantly thinking about the diversification and the allocations of where the capital stack is going. I also always like to show in each quarter what our average loan amount is, because a lot of people are shocked at how low it actually is. Well, that's a function of loan to value as well, but it also is a function of our desire to stay in a lot of states with lower property values. Okay, so again, if you were to go to the Marshall Reddick website that we've set up for this fund, and you look at that really cool graph that shows all of the states and shows all of the loans and the capital in each state, you're going to see that we're heavy in Texas, heavy in Tennessee, heavy in Indiana, heavy in Ohio, heavy in North Carolina, right? A lot of these really up and coming states that have so much room for growth. And it's not necessarily that California and Florida don't. There just is larger populations, larger values, and it's just good to maintain that diversification. Again, one of the other metrics that's on our website here that you can see under that average loan amount is going to be percentages based on our loan amount. So we do have, again, quite the variety between low loan amounts at 100 or less, and we're conscious of being overexposed at a small fund, 60 million currently, of having loans of greater than 1 million. So you can see that that's our smallest percentage at 5%. So over the 300 capital partners, as we mentioned, Cam and I are on one of the 34 MR staff. Just super proud of that number, and I really feel that any promoter, any sponsor of any type of fund really should have 10% of the capital stack that comes from in our case, a capital partner level, as well as a total capital level. So I'm very happy to see that we are there, as we really believe in what we're doing day in and day out. The mortgage investments continue to rise. This, of course, is as of October 1st. We're subsequent to that had a heavy run here in the first part of October, and we're approaching 270 mortgage investments. And we love single family homes. It's the most easily tradable asset, the most easily valuable asset, the most easily, the asset easy to fix up and to dispose of if we get ourselves in some type of situation where we have a default or a forbearance. And we have some of those, that's part of lending. And, not every loan goes as perfectly as you'd like, but from a percentage standpoint, we have so few problems. And that's where the diversity comes in. So, I mean, even a healthy percentage of defaults or late payments and so on just really doesn't have an effect on the earnings, with so many loans paying on time and working out as perfectly as possible. And at the end of the day, even those that are showing signs of problematic, if we've done our homework and we've done good underwriting, we are not at risk of losing money. And the reason for that boils down to loan to value. Okay, and we've always been under 65% loan to value, which means that we've got 35% or more borrower equity that is protecting or shielding us as the first position lender, right? So it's the borrower's equity that goes up and down when values go up and down. We could afford to see a 35% dip in values without us as the lender being upside down. We don't wish that on anybody, and certainly we haven't seen that. But at the end of the day, that loan to value really protects us. And so again, even in those uncomfortable situations where we potentially have a problematic loan, or we have to take action with an attorney and go through the acceleration, potentially the foreclosure process, we should still get our entire capital back with no loss. As far as capital raise, pretty standard. We've been between 1 and 3 million for every quarter since inception. We had 1.33 in capital redeemed this quarter. Again, that's a normal number. That's a comfortable number. You need to be able to get your capital out when you need to. And then as far as those earnings, and so that folks can kind of get some visibility, right? Our 1.47 in total earnings, we have more than 50% of the capital reinvesting. That's also helping us grow this fund, and that's a true testament to folks' desire to have this perfect mix of not only a favorable yield at north of 8%, but it's the extreme low risk. And if anything, I think like you, Cam, I'm not a risk taker. I've worked too hard to build the capital stack that I have today. And I take that approach as a money manager, and just, you know what, it's all about principal preservation, and it's about growing our capital together.
Yeah, so what's ahead? What's next, right? Well, essentially, we're just going to continue to slowly grow and raise capital towards that 100 million that Pat mentioned when we first started the fund. And we want to continue the profits and consistent distributions. We've had 19 quarters, and we want to see, like Pat said, we want to see 100 quarters. So that's definitely extremely important. And if you want to just take a look at the capital that we've raised since inception, it's only been on an upward trend. And so if you see the number here, that's going to be from the first quarter all the way till present, you'll see the amount of capital has only gone on an upward trajectory.
Again, by design.
Yeah, by design, exactly. And
it's a conservative approach that we want to take, and just make sure that we're able to keep that yield high, that every time we kind of lever up or layer up, that we're able to keep that capital deployed.
Absolutely. And while the capital is increasing, it's extremely important that the return is also staying pretty much relatively the same. We don't want to see the dip. So if you see here, it's just pretty much like a flat line since inception all the way across. So you've seen the returns. Like I said, you can find these on the website, but what you'll see is it's not going down. You're not going on a steady trajectory up. We're going with a very conservative investment, but you're also getting a great return. Right?
Yeah. Again, it goes to that conservative nature. This is a non-sexy graph, right? and folks like the sexy when it's a super trajectory upturn, and they really don't like it when it's on a super trajectory downturn. So if we like anything, we like consistency, and we just want to keep writing a check every single quarter, and we want to keep doing it, not only in our 20th quarter, which we're in now, but as we head towards 100 operational quarters, and that's literally no joke. All right, so continuing with what's ahead in the outlook, obviously we're in a very unique time. We have an election coming. We're having, potentially a lot of changes. Who knows what that holds? But what I do know is that the sun is going to come up tomorrow, and it's going to come up next week, and it's going to come up next year, and for the next 10 years after that. And if I know anything about what myself and what Cam and what we at Marshall Reddick are going to do, is we're going to put in maximum effort every single day, and we're going to do a good job for ourselves and for our clients. So when it comes to specifically our fund, we're going to really hone in on conservative valuations. We're not going to be stretching, right? We're going to be close concentration on the asset and the loan to value. Right, and that's something that I've trained my underwriting team to look at every single time they have a new application in the door, a new borrower application. It's like, would you, underwriter, like to own that property for the amount of the loan and the loan structure that you have created and assigned to it? And if the answer to that is yes, well, then we're in fabulous shape. And the reason, we're senior first lien lenders only. So the worst case scenario for us, we're going to own that property. And so again, that's a close concentration on the asset, right? We don't have to make loans because we didn't take bazillions of dollars of capital from someone else where we're being forced to deploy into loans that we potentially otherwise wouldn't have. We're also going to focus on borrower liquidity. That seems to be one of the major issues that we are seeing, and one of the larger risks to credit lenders is borrower liquidity. Borrowers are very good. They have a lot of experience. They have a lot of relationships, right? But they may be overextended with too many deals, okay? And with too many deals, they got a lot of carrying costs, including interest payments, property taxes, insurance, not to mention the renovation or the construction of the asset, the improvement of the asset, and they need the liquidity generated from sales of those assets. I mean, that's how home builders operate. And if those home builders don't have good liquidity, i.e. a lot of cash in the bank, then they could be into problems, right? So again, my underwriting team is being trained on that. We're just tightening the belt consistently and originating good loans. As I mentioned before, we are also going to be having a close geographic attention to geographic location, right? And we are focused on reducing our exposure in Florida. So it's not that we have a moratorium on funding loans in Florida, but if we're doing a loan in Florida right now, it is not going to be a stretch. It is going to be an ultra favorable loan to value. And it is going to be a borrower with great liquidity, great experience, and a long-running relationship with Marshall Reddick. And look, we don't have any major problems to report, but we do have some issues that we need to work through, and we're taking the steps necessary to do that. And that's just all a part of having a good loan committee and running a good tight ship here, to produce the best results possible. But bar none, there is just no lack of demand for private capital out there. It just becomes a function of having enough capital at the right times and funding the right deals. So again, we're going to kind of slowly lever that up. We're going to kind of watch all of these metrics. And I think it's more important to us to keep writing checks every single quarter than it is to grow the fund to a level where we start to have inefficiencies and cash drags and other things of that nature.
Awesome. I know you answered some questions if people were typing in the chat there. So thanks for that, Pat. And I guess if you have more, I mean, you may be wondering, where do you get started? What's next? Well, first, let's book a consultation together. I'd love to get on a video call, answer some of your questions, talk through scenarios, just kind of dive deeper into the fund. We'll take a look at it on the website. We'll take a look at some of the documentation we mentioned, and then we're going to get accredited. So we want to see if how we can get you accredited. I know there's a couple options there. Easiest is through income. We can also go through net worth for accreditation as well. And after we get you accredited, we're going to send you access to our investment portal. Very simple and easy to use. It's just like you have Vanguard, you'll be able to log on. You'll be able to see your investment. You'll be able to make subscriptions there. Very similar. And so, once you're on the portal, you'll sign the subscription agreement, and then you'll be making that subscription amount. And so we'll talk through the agreement. We can answer questions on that. And then last is you're going to deposit your investment and just watch your capital grow. So that's really the easiest answer I can give you for what's next. Did I miss anything, Pat?
No, that's really awesome. The one thing that I would add there is that if you are local, right, and that's all relative, right? There's always time to take a vacation to beautiful Orange County. Come and see us here in the Newport office. We just absolutely love nothing more than investors or potential investors to come and check us out, right? Check out our office, look at our operation, sit in the conference room with Cam and I. Let's get coffee, lunch, whatever works, right? It's all about relationships and getting to know the people that you're working with, and you got to like who you're working with and know that they're working day in and day out for you. We do have some questions, so thanks for being here. We'll address a few of those as we have time. I think we've got a couple of minutes here. One of the questions we had is, if we convert to a REIT, will it be a California company? Well, those are actually mutually exclusive. If you become a REIT, the income becomes taxable in the state of domicile. So wherever you live, you'll be subject only to the tax laws of that state, which is one of the beauties of a REIT. Okay, the REIT also allows for us to bring on leverage, right? Currently, we have no leverage in this fund, completely unlevered. That hasn't been a huge deal because interest rates have been high, but if interest rates go down, we could certainly increase the yield to the capital partners by borrowing cheaper money and lending it out at higher rates. We would certainly only want to do that on a very, very, very conservative level, perhaps a 10–15% leverage. But that's TBD and would only be occurring when we have a REIT. That would again block the unrelated business income tax for self-directed retirement accounts. I also have another question coming in that's talking about taking the distributions. and you can opt to reinvest them. You can change the election either way. We don't want to be changing that regularly. Our software that we manage the fund, it's good, but it's basic, okay? And so one of the follow-up questions there is, can we do a fractionalization of the earnings? Can we take, say, 50% and reinvest 50%? Or can I say take $3,000 of the quarterly earnings and reinvest the balance? We do have the ability somewhat to do that, but we have limitations in our software. So the one ways that we can do that is by splitting your investment position. So if you were at the point in time where you were at 100 or the 500 or the 3 million, you wouldn't want to do that. But if you're under 500,000, we could certainly split you into two positions, with one of them reinvesting and one of them taking. And a lot of times the reason for that is folks are like, well, if I reinvest all of it, I still owe income tax on the earnings and I'm getting no cash for that. That's certainly something to think about. But as Cam and I talked about, for me, that's a forced savings plan, right? All of those earnings that I'm getting, and they are significant as I've grown my position over the years, right? That money, I have to write a check to the government for the tax liability on those earnings. But guess what? All of those earnings that are in there are now tax-free. So when I take them out, I don't have to pay any income tax on it. So I just rather, work hard, pay all that income tax, and I'm growing my position and taking advantage of that compounding. And it's just forcing me to save every single month. Whereas a lot of people have a hard time saving, right? They spend up to their means. And certainly if I had an extra, $15,000, $20,000 in my checking account every month, I might be inclined to take more vacations or to spend it on more new cars or to do something. But because I don't have it there, I don't spend it. Cam, any other questions that come up for you often?
Man, you got a lot of good answers there. I think we answered a lot of the questions that we saw, just in regards, you talked over what the loss reserve was, you described the REIT, you talked about our plans with diversification in Florida. I think you answered most of the ones that I see on a regular basis.
Yeah, absolutely. One last question before we go. We do have somebody asking about, we've mentioned 100 million a couple times. What happens when we hit 100 million? Well, the answer to that is nothing technically. That was just our goal. That was what we wanted to do. Potentially, we may split off. We may start a new fund. Right? We may have a levered fund and an unlevered fund. We may have a REIT and a non-REIT. There are all these different things that are happening that we're thinking about. But again, a lot of those are going to be based on legislation that is favorable to those different types of funds. Because if I've learned anything about running and managing other folks' capital and people with a lot of money, tax implications are big. Right? So we've got to figure out how to reduce the taxable liability to our clientele. And when we can do that, right, we're going to have unlimited capital at our disposal for, again, this laser focus on solid loan to value, solid assets, solid geographic locations in first lien, non-owner occupied positions. So Cam, thanks for joining me tonight. This has been a pleasure.
Thank you, Pat.
And thanks to everybody else that's out here. Thanks for joining us. If you have any questions, feel free to hit up Cam. I'll also, time is limited, but I'll try to meet with you as many as possible on an ongoing basis. So thanks again. Appreciate your partnership, everybody, and go Dodgers.
Yeah, thanks everybody. Have a good night.
Bye-bye.